Do you need to pass a test to trade options? If someone has told you that you need to have a Series 3 or Series 7 to trade options in the options market, you're being lied to. And by you believing in that lie, you can miss out on a lot of opportunity. You can miss out on a lot of opportunities for you to drive more income into your situation because you believe that you need to have a license or you need to pass a test to trade options. What we're going to talk about in this video is what the Series 3 is, what the Series 7 is, who that actually refers to, in fact, that they need to pass that test and get licensed, what the futures market is, and then how it relates to you as a retail trader. Let's go ahead and get into it. Now, many people have been told because of miseducation or misinformation that for them to be credible or for them to be competent as a trader, they need to get a Series 3 or Series 7. And we have to understand is that when you really understand what those particular tests mean, they relate to specific things, right? And if you're not involved in those type of things, then you don't need to be involved in taking that test. And what's going to happen to a lot of people is that because they're going to listen to this information and not do any further investigation on what they're told, they're going to believe this and then feel like, well, you know what? Because I may not know how to take this test, I may not want to take this test, I may not be confident I can pass this test, I don't go in this particular area because I'm believing what somebody told me who also didn't know what they were talking about, or maybe they were just disinforming you or misinforming you. So let's go ahead and talk about what the Series 3 and what the Series 7 is, so you can kind of understand what people are talking about when they reference these testing or this particular licensing, right? Let me go ahead and zoom this in a little bit more, and let me share this screen out. So let's look at the Series 3, right? So what is the Series 3? So the Series 3 is an exam, also known as a National Commodities Futures Examination. It's administered by FINRA on behalf of National Futures Association. So candidates who pass the exam are eligible to register with the NFA, sell commodities futures contracts and options on commodities futures contracts, right? Then we talk about what the Series 7 is. So the Series 7 exam licenses the holder to sell all types of security product except commodities and futures, known as a General Securities Representation Qualification Exam. It's also licensed by FINRA, and stockbrokers inside the United States need to pass the Series 7 exam to obtain a license to trade. Now, what a lot of people are not understanding is that, one, they're not a stockbroker, and then many of them are not trading futures on behalf of somebody else, okay? However, when you don't necessarily understand this space, you don't necessarily understand where you fit in the space. The majority of people that are going to be looking to get a brokerage account and trade on behalf of themselves are what we classify as retail traders. Retail traders do not need a specific license to trade their own retail account. And a lot of this licensing was done because it wanted people to kind of make sure they kind of knew what they were doing from a technical and from a, I would say, a definition standpoint before they started to trade. It doesn't mean that they can actually trade. Therefore, we have thousands of people that have passed their Series 7. Most importantly, we got thousands of people that have passed their Series 3 and they couldn't make it as traders. Why? Because they can't trade. So being able to pass the test doesn't mean that you know how to trade. It doesn't mean you're going to be a successful trader. Okay? Then you got to realize if you're going to pass the Series 7, you got to be sponsored by somebody to take the FINRA test, because I wanted to take the Series 7. But you got to be sponsored by somebody, which means what? You have to be working for somebody. Therefore, unless you want to go get a job and have somebody sponsor you to go take the FINRA test, there's really not a lot of opportunities for you to take it because you just can't go in there and take it as an independent person, right? The Series 3 didn't see a need to take that test because I don't trade futures, right? So when people hear options, they think options are relating to options on equities. And it's because of lack of understanding and a lack of miseducation about how the space actually works. So we're going to get a little bit deep because you may one day want to go trade futures. But I want you to understand first, this market is changing. What do I mean by that? We're going into algo-based trading. The question I have for people that think that you need a license to trade, the question I would ask is, does a computer need a license to trade? Right? Because we're going more and more to algo-based trading where a lot of the trading is being done with computer programs. Therefore, does a computer need to pass a Series 3 or Series 7 to trade? Because the narrative is that you're not competent as a trader until you pass these tests. Well, does a computer need to pass the test? And then how do we get a computer to have sufficient artificial intelligence to pass that particular test to where now we're confident that that computer is going to make all the right decisions in trading in its trading activity. Right? These tests were created back when the majority of trading was done via people. And so we're going to get a little bit deeper into the futures market, what this actually means. So if you do decide to go in this particular area, you understand what somebody may ask for you. But as a retail trader, you don't need to pass any of these tests to actually be able to open up a brokerage account and trade, whether it's futures, whether it's any type of derivative product that your brokerage may allow you to trade. So your biggest question is, will the brokerage allow me to trade this product? Right? Will the brokerage allow you to trade the product or this particular, mechanism? If they allow you to do it, then you can do it. That's the only thing you need to be worried about. You don't need to be worried about what somebody outside of that relationship. So your relationship with a trader is between you and your brokerage and maybe the SEC. Outside of that, nobody else matters because they're not in that relationship. So often it's going to be a two-party relationship or a three-party relationship. Now, when we talk about the futures market, what I want you to understand, because we're going to get a little bit deeper into that. The futures market essentially was created by farmers, right? It was created by farmers. And the reason why it was created by farmers is because farmers a lot of time expend a lot of upfront capital to grow crops. And then they can be on the hook if the market is soft when they take the crops to market. So if I got to spend a certain amount of money to grow crops, I got to outlay a certain amount of capital, and the market is soft when I get ready to go take it to market. What I mean the market is soft, I mean it's not a really robust market at that time. I may make less on when I take it to market than what I put into it to grow it. So what a lot of farmers started doing is trying to figure out, can I get somebody to essentially contract or agree to pay me upfront for product based on how the market currently is at that particular time. Now, that can be a good or bad, because when you take it to market, you may figure out that you underbid your own market, but at least you got a locked in price guaranteed. So when we start talking about the futures market, the first futures market was created in Japan, right? And it was called the Domo Rice Exchange, right? And we're talking about in the early 1700s, right? They created this particular futures market based around rice. And this was an actual physical market. And so you got to realize is that this concept of playing options and hedging against your future or buying insurance policies on the downside of the market is not something that's new. In fact, it's something that's extremely old. And it was done with people, right? It wasn't done with machines or computers. And so this is why I try to tell everybody is that the understanding the principles of this market aren't based on you needing a computer, because when they started these marketplaces, there were no computers around. And so in this particular place in Japan, they had a really robust futures market with no computers. Okay. Then we transitioned into some of the futures market that we saw in the United States from there on out to where it was very physical. And then now we transitioned into a space where a lot of the futures market now is all electronic. And so let's go into some videos, because what I don't think is that we've been exposed to these marketplaces. We don't even know they exist. So we're first going to go into a video about the Chicago Mercantile Exchange. And, there's a narrative about Chicago being put out by the media. Chicago is one of the financial centers of the world, right? It has been for a very long time. But that part of Chicago doesn't get the attention because it's not entertaining to a lot of people, right? But if you understand the financial activity in Chicago, you understand why that's a really, really important city. So we're going to talk about the Chicago Merc and how at one time futures traders conducted themselves in the Merc, so you can kind of get a better understanding of a person that was licensed, what they had to do on a day-to-day level. Let's get into it.
My name's Mike Quattrocchi. I'm a floor trader at the Chicago Mercantile Exchange in the live cattle options and futures pit. I buy and sell futures contracts based on the live cattle contract.
All day long, Quattrocchi trades cattle by the thousands.
Your adrenaline is going very fast. You're asked to do complicated math quickly in a very, very split-second maneuver. There's lots of pushing, lots of shoving.
Today, Mike Quattrocchi works the floor, although 80% of futures trades at the Chicago Merc are conducted online.
When you look at the big markets of the West, you see people dealing in symbols. All they deal with are representations of value.
What I'm trading today is is roughly 1,000 futures contracts. That represents about 40,000 head of cattle. There's no physical way that we could ever transact that if we actually had to go out to a farm or a ranch and round up the cattle and buy and sell them with each other. I never see this cattle. I actually have never been outside of Chicago to the west to see where these animals are.
Okay, so that particular guy works at Chicago Merc, and what I wanted to show you was how people were transacting futures contracts from a physical standpoint. And the reason why that's going to be important is because they're no longer going to be doing that. So what we saw in the pandemic is a lot of people got pushed out of the physical marketplace. They moved everybody to computers, and that's pretty much how they're going to run everything from here on out. So we still will have a small amount of people trading via the physical space, still do a little bit of that to CBOE, but a lot of this has been pushed into the electronic space. So we want to ask ourselves again, if computers are going to be doing the majority of trading and we're going to be using quants to program the computers to do the majority of the trading, will licensing still be important? Because it's not going to be the actual human that's going to be doing the trading anyway. But why do people have more confidence that the computer's going to make the right decision than they do in the actual human being making the right decision? Now, what we're going to do is kind of roll into what the futures market actually is, so you can understand that this market actually exists. It's one of the biggest markets in the world, and it's based on trading commodities, right? Which is something that the average person consumes. So if you go into your kitchen, you go into your house, you're going to have a large variety of different commodities inside your house. And a majority of those particular products are traded on the commodities market. And if not in the United States, it's another part of the world. But really quickly, before we go to that video, we want to talk about the sponsor of the show. It's www.thehighestpaid.online. That's an online training academy for 3 people. Person that doesn't like the fact that they make a certain amount of money this year and they're dissatisfied with that. The person that doesn't like the fact that there's a cap on their income, even though the inflation rate keeps going up. And the person that doesn't like the fact that they got to take a lot of time away from their family to make the money that they make. We figured out how to solve that particular problem by showing people how to leverage the options market. And you don't have to be licensed to take a test to operate in that particular market as a retail trader. So I would encourage you to look into that particular situation and to make a decision on that, because we're going to eventually raise the price, because it's a course where we keep adding content to it. So it's not a fixed situation. And let's get back to the videos, right? So let's now look at the actual futures market and what that actually entails. Let me get rid of this banner and let's get right to it.
A $3 box of corn cereal stays at roughly the same price day to day and week to week. But corn prices can change daily, sometimes by a few cents, sometimes by a lot more. Why does the cost of processed foods generally stay quite stable, even though the crops that go into them have prices that fluctuate? It's partly thanks to the futures market. The futures market allows the people who sell and buy large quantities of corn to insulate you, the consumer, from those changes, without going out of business themselves. Let's meet our corn producer, this farmer. Of course, she's always looking to sell her corn at a high price. And on the other side, our corn user, this cereal company, is always looking to buy corn at a low price. Now, the farmer has a little bit of a problem because her whole crop gets harvested at once. Lots and lots of farmers will be harvesting at the same time, and the huge supply can send the price falling. And even though that price might be appealing to the company that makes cereal from corn, it doesn't want to purchase all of its corn at once because, among other reasons, it would have to pay to store it. But it's fortunate that corn can be stored, because that means it can be sold and bought throughout the year. And this is where the futures market fits in. Buyers and sellers move bushels around in the market, though actual corn rarely changes hands. Instead of buying and selling corn, the farmer and cereal maker buy and sell contracts. Now we're getting closer to peace of mind for both sides, because a futures contract provides a hedge against a change in the price. This way, neither side is stuck with only whatever the market price is when they want to buy or sell. These contracts can be made at any time, even before the farmer plants the corn. She'll use the futures market to sell some of her anticipated crop on a certain date in the future. Of course, she's not going to sell all of her corn on that contract. just enough corn to reassure her that a low price at harvest won't ruin her business. The contract provides that security. The cereal company uses the same market to buy bushels. Their contract protects against a high price later. Contracts will gain or lose money in the futures market. If the price goes high, the farmer loses money on that futures contract because she's stuck with it. But that's okay, because now she can sell the rest of her corn, what wasn't in that contract, at the higher price. That offsets her loss in the futures market. If, at harvest time, the price of corn is low, well, that's exactly why she entered the futures market. The low price means her contract makes money, so that profit shields her from the sting of the low price she'll get for the bushels she sells now. The corn cereal company doesn't like those higher prices, and that's why they have a futures contract. They make money on it and can use that profit to cover the higher price of the corn they now need to buy. The futures market serves as a risk management tool. It doesn't maximize profit. Instead, it focuses on balance. And in this way, it keeps your cereal from breaking your weekly shopping budget.
That was a really good basic understanding of the futures market to get people to kind of understand how this market actually works and the mechanisms behind it. Because the job of the market, what both parties want is price stability. What they don't want to deal with is massive price fluctuations, right? So what they're looking to do is say, I'll take a little bit less profit. I'll take a little bit less guaranteed profit to get price stability. And so that's what futures traders actually operate. And so these particular contracts can be traded by traders, whether or not they can deliver the actual physical at the end of the day, because it's not about that. It's about the actual marketplace for these futures contracts. But what we wanted to really get people to understand is that you can be asked as a physical trader, if you're working for somebody, you're working for a firm, to take the Series 3, take the Series 7. Also doesn't mean that you know how to trade. It also doesn't mean you're going to be successful as a trader. A lot of traders with those particular certifications or those licenses, they still wash out because they just don't know how to make trades, right? It also doesn't mean that if you don't have it, it doesn't mean you don't know what you're talking about. And it doesn't mean that you cannot be a successful trader. And therefore, what you want to understand is for what you're trying to do in your individual situation, what is going to be required of you. And oftentimes, the certification or the licensing is required when you're getting ready to work for somebody else, or you're doing a particular job with the public where you're servicing people and the actual government has demanded that you need that license. If you're going to just do it for yourself, you don't necessarily always need to get that licensing, because the only person that's going to be harmed if you do it incorrectly is going to be you. And you have all the right in the world to harm yourself. And that's what I want you to understand. So we're going to go through the comments and we're going to get up out of here because I knew this wasn't going to be a long video. So Caddy Williams asked about my Cash App. It's in the actual stream going on right now. Corporate checks, man, I appreciate the $5 super chat. Hope everybody got value from this video. David W. Williams, also known as Diamond Dave. I'll talk to you later.